Hey everyone, how are you now? I've got some stats for you about where this market is at the moment, and that's sort of what that's all about. Here's a good one. Apple and Microsoft, and this is going into Friday morning. This has come off a beautiful Twitter account, which I can't remember where I got it from, but I know that it must be true. That Apple and Microsoft have accounted for nearly 50% of the S&P 500's year-to-date moves. That's huge. Two stocks, half of the moves. The rest of the FANG has accounted for a whopping 94% of the S&P 500's return year-to-date. Amazon, and Amazon reported late last week, going into the close with the beats. FANG outperformance could account for the entire S&P 500 gain when the US opens on Friday last week. Microsoft has accounted, I can't even say this properly, 140% of the NASDAQ move on Thursday. So technically the NASDAQ equal weighted index was down whilst the weighted index was up. And that just shows you how much weighting and pull those companies actually have on the market right now. Now, those aren't bad companies. This isn't a bad situation. It's probably bad when it comes to breadth. You'd rather there was more across the board moves to go in an upwards direction. However, you've only got these two stocks, three stocks, four stocks maybe at best, making most of the moves for the index. That's a bad situation to have, especially if those stocks stop marching. However, those stocks aren't really required to stop marching. I don't think that they will. They're not expected to. So just take it easy. That's where a lot of people are saying, oh, watch out, because when the generals stop marching, beware, and there's not enough breadth, it's not a good sign. That's it. Another interesting sign, which is coming up here as well, is, first off, we're in May, and everyone's talking over all this selling May go away situation is very interesting. The way that people play the May story, myself, I would like to maybe shave off, I just want to shave off small amounts of profit in some of the tech that we hold, because they are amazing profits and they just go in, and that's what you should just do, to shave them off, depending on if it's appropriate for your clients. And just have a little bit of profits, maybe have a look at the bond market as being somewhere to locate it, because the market now seems to make sense now. However, that's up to you. Now, tech is continuing to go up higher and go up higher. What is also something that has gone up higher is that we've got the most short S&P 500 futures since, 2011. So it's going back some time now, 12 years, I believe that is. That is the most short position that has been in the S&P 500 futures market. Now, that's okay. A lot of people equate that with being, then you get a slingshot up. You get a few things happening to the upside, some half-decent reporting, which has been better than expected. All those expectations were down. You get a few of the closing of the shorts, some more of the rally, and then everyone has to close the shorts, and the slingshot continues and the market goes up. That's usually what would happen in this situation. However, that happens when the Fed is being monetarily accommodative. I managed to get that out quite well. Thank you. Welcome to Mondays. But right now, they are not being accommodative. You've actually got an inverted yield curve as opposed to a steep yield curve that you've had every single time in the past where you've had these massive short positions in the market that have slingshotted up. That's been when you've had a nice, simple, steep yield curve. The simplest yield curve is just the 210 yield curve. Okay, don't overcomplicate things with this one. It's the one that everyone talks about. That's how it's going to go. That's usually been steeper, in that the 10-year is paying a higher yield than the 2. But as it is now, the yield curve is actually massively inverted, and it's the most inverted that it's been since the 1980s. That's not amazing, especially if you're putting that in sync with where these short positions are. When that has happened before, that has usually been that the shorters are correct. So again, what are you going to play? Now, I'm going to keep on going. So the yield curve, yes, the yield curve is inverted. That means that these short positions may be correct, or would usually be correct in the past. It doesn't mean that they're going to be. None of this is actually guaranteed. Because right now, this is what I'm saying, is that we've got these two sort of things. We've got a market which is absolutely powering ahead. Look at these tech stocks going ahead. Microsoft with their expectations. Amazon going amazingly well. We've also got a labour market which seems very tight. Spending is still fine. And it's not in recessionary territory like yet, but it's definitely slowing down. So it's not amazing. However, what we're seeing is that if we do get into that recessionary territory, then we're going to see the Fed start to ease back, and easing back would also be good for those stocks. You see an easing back in the Fed rate. It's always accommodative to stocks. Usually it's accommodative to stocks. However, in the past, it's been when the Fed ceases the hiking and the pause starts. That's when markets usually come back down. Play that as it lies. Also, next stat that I've got here. The Bloomberg Large Bankruptcies Index. There's $50 million plus companies. What we have now in 2023, we're up to 70. This is in the US. We're up to 70 companies. Last year, No, 2020 was the second worst on history. That was 71 companies. So those two numbers, so this year's bankruptcies and 2020 are actually very close. The biggest was 2009. They had 118 bankruptcies. Now, I've said this many times before, that the Fed and various government agencies that are actually government agencies, because the Fed's not, don't forget that, that they're better equipped to fix the things that are broken than they were back in 2009. So we saw that when COVID hit, how quickly they could put fixes in place to be able to support everyone and sustain everything. And we're seeing now in 2023, when the big ones look like they're about to hit the wall, how quickly those fixes could come in. So that's something just to pay attention to. Insolvent bankruptcies are going up and are heading towards record highs. But you wouldn't really know from the market, would you? Because the market seems to continue to want to power ahead based on a few stocks, and whilst the economy sort of detracts in a different direction. However, like I said, labour market is still very strong. Wages are still fairly strong. We're seeing just two different sort of things all telling us different directions. Now, where are we at to? Yeah, the S&P, don't worry about that. Inverted yield curve, fantastic, it's good. What to do in the case of a pause? In the case of a pause, you want to see defensive health, defensive health and stables. A Macquarie Bank note that came out late last week, talking about where you'd want to be in a market of when the RBA, this isn't the Fed, so now I've gone local now, so there you go, sorry for that. When the RBA does move into a pause, what are the best things to own? Usually it's health and staples, so they're the two ones. And look, you can figure out exactly which ones you're going to go into if you want to go into those particular things, but that's what it is. So bond yields typically fall after the pause. Earnings downgrades continue because that's a result of the slower growth that caused the RBA to pause. And defensives are usually the place to be when those sorts of things go on. It's really that simple. Don't overcomplicate things, especially this year. You know what's going to happen. Last, I wanted to talk about a UBS podcast that I heard just over the weekend, talking to, and his name is Joe Zeidel. Now he's head of chief investment strategist for Blackstone. Blackstone own pretty much everything. They've got 700,000 people, employees, under various groups that they own across every single sector of the market. So they see everything across the space. He was talking about his real estate portfolio, and that data centers are as big, and this is the actual quote, in private real estate, we are quickly becoming one of the largest data center owners in the world. And I think that data centers will be as meaningful as logistics business for us in the real estate portfolio. The need for data is only going up. And he mentioned a whole lot of stuff about artificial intelligence, the usage, and going up through the roof. I happen to believe that, and I'm happen to 100% behind that. So we had a look at some of the ETFs, and they're not really awe-inspiring because they're caught up with a lot of the commercial property situation in the US. So we just had a look at some of the single stocks. We're having a look at Equinix. They report in 2 days. I personally think that Equinix will be quite bullish, and that their reporting will most probably be okay because they've had a really good consistent earnings report over the past. I think that will continue on this one. Slight increase in dividends probably, but everything will sort of be okay. Their margins are amazing. However, what I think that they'll do is that they'll talk about exactly how much artificial intelligence is impacting their business to the upside and how much of an upside swing they've got on that case. So Equinix, I'm going to be buying some call options tonight on that one. I don't want to charge in and buy a long stock a couple of days before earnings because there's always a thing that's in earnings that could potentially shock you, and I don't want to have that initial 10% potentially swing around earnings time. It's just not good unless it's to the upside. So that's why I'm capping up with the options trade that's in there. So those are those ones. However, there's going to be a managed fund for that as well that's out there. So look, there's a few ideas for you. If you can find something that's in data centers, some managed funds in data centers, and I'm trying to pull them up for the rest of the week and have a bit of a look at what's going on there. But look, Equinix is the biggest name in that holding, and that's the individual stock. So have a bit of a look there. But data centers to do with artificial intelligence right now, that's the hot side that you want to be in, and that's something that maybe you just want to have a bit of a look at there. So that's all that I've got time for today, and I hope that you enjoy that, and I hope that there's something that you can get involved with in that one, and I hope that you've got lots of questions and that you do your own research on this one as well. Until then, have yourself a good evening and have yourself a great week.